Preparing the statement of cash flows by using the indirect method. As you recall that in order to calculate the operating cash flows based on the indirect method, we will start with the net income figure, which appears on the income statement, and that is calculated based on the accrual basis. Then we will carry out several adjustments to recognize only the cash effects and ultimately reconcile with the cash figure resulting from operations. In other words, if the net income figure is to be modified to a net cash collected or paid figure, what type of adjustments on account of non-cash items that has already impacted the net income figure need to be made to arrive at the cash figure? Let's assume that a business had revenue of $100,000 and expenses of $65,000. The net income according to the accrual basis is $35,000. If we assume that all revenues are collected in cash and all expenses are paid in cash, the cash flows from operation is equal to net income in this case. But this assumption is not valid, as for all practical purposes, a business has credit and other transactions where cash may not exchange hands. We could have a case where a customer buys goods for, let's say, $20,000 on account. This is regarded as revenue according to the accrual basis and will be included in the operating income. But no cash flow is involved and hence it shouldn't appear as cash revenue collected in the statement of cash flows. Assuming that this is the only sales done on account during the period and that the beginning accounts receivable balance is zero, we can expect that the account receivable debit balance to be $20,000 at the end of the period. The account receivable balance increased, indicating that some of the revenues are not collected and hence the revenue according to the cash basis will go down by $20,000 and the cash collected from customers will be equal to $100,000, which is the revenue according to the accrual basis, minus $20,000, which is the increase in account receivable, to get $80,000 of cash collection from customers. If we assume that expenses were paid in cash, then the cash flow from operations is equal to $80,000 minus $65,000, which is $15,000. Accordingly, we can adjust the net income figure by the change in accounts receivable to reach to this figure as follows. In this case, the account receivable increased by $20,000, which means that we didn't collect such an amount, which indicates that the cash flow from operation is less than net income by $20,000. Hence, we will subtract $20,000 from net income to get the cash flow from operating activities. Now, how can we test our assumption that all expenses are paid in cash? If we assume that the business started the period with a zero balance of accounts payable and ended the period with an accounts payable balance of $5,000, this means that this amount is not paid yet to suppliers. So, even though the expenses appear on the income statement with $65,000, however, they are not all paid in cash, rather only $60,000 is paid in cash and the remaining $5,000 is to be paid later. So, the operating cash flows balance in this case is $20,000. To adjust the net income, we will add back the $5,000 to the net income figure, which were previously deducted in the $65,000 of expenses as they were not paid. So the adjusted net income figure now matches the operating cash flows. Let's summarize and come up with a general rule based on what we illustrated up till now. When account receivable or any asset account increases, we will subtract from net income, as this means that we didn't collect all the revenues or we may have both assets, which will result in a decrease in cash. When accounts payable, which is a liability, increases, we will add, as this means that we didn't pay and hence cash didn't decrease. Now, what if the opposite happens? What if assets decrease? Shall we add? And if liabilities decrease, shall we subtract? The answer is yes. Let's illustrate. Let's use the same figures of the previous example where we had revenues of $100,000 and expenses of $65,000. Now let's assume that the account receivable account had a beginning balance of $20,000 and at the end of the period it decreased to zero. This means that all our sales were in cash and additionally customers from previous periods paid what they owed to the business. This will result in cash collections of $120,000. Assuming that all expenses are paid in cash, the business should have $55,000 as cash flows from operations. To derive cash flows from operations from the net income figure, we need to adjust it by adding $20,000 to it. So when assets decreased, we added. The resulting net income figure matches the cash that the business has. Now let's test the assumption that all expenses are paid in cash. We found that the accounts payable had a beginning balance of $5,000 and at the end of the period had a zero balance as the company paid what it owed. Accordingly, in addition to the $65,000 expenses, the company had paid an additional $5,000. So the total cash disbursement would be $70,000, the $65,000 plus the additional $5,000. Hence, cash from operations would be $120,000 minus $70,000, which is equal to $50,000. To derive cash flows from operations from net income, we need to subtract $5,000 as it is paid in addition to the expenses that are already deducted from net income. So the adjusted net income figure would be $50,000, which matches the cash flows from operations. Remember that when liabilities decrease, we subtract from net income. The summary of the adjusting rules to net income up till now is as follows. When assets increase, we subtract. When liabilities increase, we add. When assets decrease, we add. When liabilities decrease, we subtract. You will notice that to adjust assets, the adjustment is against the direction of the change. If assets increase, we subtract, and when they decrease, we add, while for liabilities, the adjustments are in the same direction of change. That is, when liabilities increase, we add, and when they decrease, we subtract. Additional to these adjustments, there are other expenses that might affect the net income that is prepared on accrual basis. For example, depreciation expense. If the business had reported within its expenses $3,000 of depreciation expense, as you recall that depreciation expense is a non-cash expense, which means that we paid less cash than the $70,000 reported earlier. So the amount of cash dispersed is only $67,000. And the cash flow from operations is $53,000. To adjust the net income, we need to add the depreciation expense back as it was deducted when we calculated net income, which is based on accrual basis, without any actual cash payment. So $3,000 are added back to get net cash flows from operation of $53,000, which matches with the cash balance as per the company's records. Assuming that all expenses are paid in cash, the business should have $55,000 as cash flows from operations. To derive cash flows from operations from the net income figure, we need to adjust it by adding $20,000 to it. So when assets decreased, we added. The resulting net income figure matches the cash that the business has. Other things to consider. Now let's assume that the business sold an asset and made a gain of $25,000. The gain is included in net income. Let's further assume that all revenues and expenses are collected and paid in cash. If we calculated cash flows from operating activities, we will exclude the gain on sale of assets, as selling of long-term assets is not considered an operating activity. Since gain on sale of assets is included in the net income, So we have to exclude it from net income when we are adjusting net income to reflect cash flows from operating activities. This will prevent double counting such gain as well. Accordingly, it should be subtracted from net income. The same applies if the sales of an asset resulted in a loss. The loss is subtracted when calculating net income according to the accrual basis. However, it is not considered as an operating activity. Accordingly, it will be excluded by adding it back, as it is going to be included in the investing activities. This avoids double counting it. Let's return back to the summary of adjusting the net income to cash flows. Now we can add the following points to the summary. Gain on sale of assets is subtracted and loss on sale of assets is added.